Okay, so there really hasn't been a huge amount of change since last month, to be honest. A lot of the same sort of things that we're looking at. So I think the big picture, remember, is the Fed balance sheet expansion continues, and so that money is sloshing into markets. But a lot of projections from a lot of people are now showing maybe a peak this quarter or sometime early next quarter for QE, and then maybe it starts coming off the boil. So the Fed's foot's still on the floorboards for QE stimulus, but now there are thoughts about coming off of full-scale stimulus by some of the Fed hawks, not by the doves. And so we need to watch out, because eventually, when there is real taper talk, you're likely to get a negative reaction from the market. So we want to watch out for a string of strong labor and growth reports, towards Q3 sometime at that point in time. And so that's really kind of the main thing we're going to watch for, and market internals going along with that. So if we start getting to an environment that seems like it's way too risky based on divergences and based on that sort of narrative, that's what we're going to be more concerned about. And that's when I think we have a good chance of a sort of a more major correction than we've had since March 2020. What I would say is we didn't really get number one of that string of good labor reports in the last two labor reports. And so Friday's NFP report really was weaker than expected. So the job growth wasn't as strong as expected. We had actually a decline in some components that was negative as well. The labor force participation was lower. So that means, really it's a lot of people not looking for work. More people not looking for work. That was one of the reasons the unemployment rate went down. So just keep in mind, we had 20.5 million jobs lost in the recession in 2020. That's about somewhere more than 6 times the normal recession since World War II, and about 4 times larger than the worst recession since 1940. So this has been by far off the charts in terms of job losses, and we've come back at a strong pace, but we're still down 7.5, 7.6 million jobs from where we were before the recession. That's actually worse than the deepest of any recession we've had since 1940. So the doves really do have some real reason behind what they're saying of not pulling off of stimulus. We've got still a huge, massive unemployment problem. So they're likely to keep on with stimulus, although the hawks will start now wanting to discuss coming off. So just realize that as long as the stimulus is not coming off the boil, there are going to be flows continuing into the market. We've had this nice uptrend channel, kind of got near support at the lows. We're now kind of flirting with the highs. I suspect that this lower uptrend channel will hold until we get bigger divergences in the market. And sometime ahead this summer, we're likely to break through. And once we do, then we're probably looking at 42.80, 43.50 as kind of a next zone, if we can get a good breakout with the S&P and with some of these other indexes and components of the market participating. Right now, and is the case in May, we really don't have the kinds of internal divergences that you normally get before a major correction. You can have short-term corrections, you can have normal corrections, but it's very rare. It's not impossible. Occasionally you'll get it, but very rare that you do get a major correction without weeks to months of these kinds of internal divergences that we just don't have at all right now. So we're actually getting new highs in the Nice advanced decline line, in the Nice cumulative net volume line, and even in our net points indicator, which is XVG. So all three of those making new highs generally lead to eventual new highs in the index. And even the net new highs was not divergent the last time that the S&P was making new highs, so there's not really much divergence there. All right, now we do have some behavior in our supply and demand indexes. It's a little bit less than positive. We've had some pretty big corrections. But now we're back in a mode where it's starting to look like if we can break through, if we can get some small cap participation and some other things that kind of confirm follow through here, we could get another light wave up. And so here we have the supply index, and it's really in the kind of the best shape. It's broken down before former lows. Remember, supply falls in bullish moves, and it's fallen below these former lows, and it's below its 40 DMA, and it's broken its uptrend line. So it's really in gear for a rally mode. So supply is not really the problem anymore. And since, in the last month or so, supply really hasn't been the problem. The problem has been demand. And so demand has come off here. And usually when you get one coming off, so you got this rise in supply, but during that period you had a rise in demand too. So that's kind of a normal correction, not a major correction. When you get your major corrections is when you have supply rising and demand falling at the same point in time. Haven't really had that. So, but we have had demand peaking and coming off. It's done that well. Supply has also come off. And so the net result has been sort of a trading range in this spread, which is demand minus supply. It has turned up. It's now above its 40 DMA and above its 200 DMA in positive mode. Would really get better if we can see it move above its prior peak at 438.10. So we'll look for demand to break out and for the spread to break out ahead to really confirm that it's a better environment. We're starting to get we've got some short-term models that have turned more positive, but they're really marginal still. And so we really need some confirmation still to suggest that we're in a more positive environment. And one of the things that's a major component of that is the performance of small caps. Small caps have really been going sideways since March. We've sort of in this range, and we have flirted with resistance, but not really clearly broken through. A breakthrough, a close above 231 on strong volume, maybe even a breakthrough on this relative strength above this base since April. Those are the kinds of things that would tell us that, okay, we're getting in a better environment. It's much a safer environment to add exposure more aggressively. We're trying to inch there, but we're not quite there yet. Now, one of the things to realize as we watch this is that we do have the CPI report on Thursday. Last time we had a CPI report coming due, markets started to get concerned a couple days before. So that's starting maybe tomorrow or Wednesday. And I think what happens in this CPI report is going to be important, and particularly what the reaction of markets is. If we can get through that without too much damage to stocks and then start to head up again and break through these levels after that report, that's when I think you really got a green light. You can add more exposure should we get that. And a lot of people are talking about how this sort of consolidation hasn't been severe, but it has been long enough that actually after this earnings season, we are seeing that the value of small caps really pick up compared to other asset classes. So that could be something that if we get a better environment starting, could help fuel more of a rally. Now, beyond that, if we do break out, we do start going sometime this summer, which is quite possible, really watch the VIX. And as we've said, you get down below 13 on that VIX, that's when you start getting these environments where you have to be worried about the degree of complacency in the market. That's when you could even consider, watching for days to weeks and then weeks to months of internal divergences to confirm that if you've been below 13 on the VIX and you're getting that, that might be a good time to put on some VIX hedges. And you could nibble on some longer term plays in the VIX once you get under 13 as partial hedges. The CPI report this looks like it's still headed higher. There could be some near-term risk for the market, as we've said. But one thing to look at that the markets really haven't been paying a lot of attention to, the last report we had from the CPI, it showed a huge increase in year over year, which everybody was expecting, but it also showed a little bit of deceleration in the month over month numbers, and that was surprising because at the last month with the CPI was the weakest comparison numbers. So now we're theoretically starting to come off not as weak in numbers in terms of the CPI over the last year. And so if we continue to get some month over month deceleration in the growth, the market could actually take that report positively. So I think it's like an NFP in terms of its import, and it could be a catalyst for either direction. We really have to watch the market reaction to it in particular. I think that should we get an inflation report that impacts bonds negatively, I think you kind of want to watch the belly of the curve, some of the intermediate term durations that haven't really reacted as much as the long side for any kind of potential shorting that you want to do in bonds.